For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and health care? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future. All right, this is Managing Your Financial Future. It's the name of the show, Professor Plum.
Got it right on the third take.
Right on the third take. Yeah, no. I was half a second into the show, and I started to say this is the. I almost gave the old name of our one of our radio shows from a long time ago. Johnny Dean, your podcast host. Welcome back to everybody who's subscribed to our podcast and everybody who's all of our longtime listeners. I know we're slowly approaching, Professor Plum, our 200th episode.
Wow.
Sometime in the next couple of months. Don't know if we're doing anything big because we didn't do anything big for 100. But they say, you know what they say, that a podcast that most podcasts don't make it past episode 5, I think is what they said.
Oh, okay.
So the fact that we made it, 180 even beyond that or whatever it is, says something to...
Hey, we're doing something.
Yeah, well, to our longevity, and I hope to our popularity. We appreciate everybody writing in and asking us questions. We try to answer them as best we can, or we just take some of the questions and we make them into topics. And today's topic has to do with something, sort of dovetails from something we talked about, I don't know, an episode or so ago, where we mentioned stocks, Professor Plum.
Well, we mention them quite often.
As being the most volatile and in some cases the riskiest, I suppose, asset in your entire portfolio, depending upon how you use them. They're either risky or they're not.
Well, risk has to do with the time horizon that you're allowing for it as well.
Well, exactly. So if you're using them for short-term
that becomes risky
liabilities, you are taking on an enormous risk.
You could do really well, or you could do very poorly.
Yes, exactly. So this begs the question, and it's a common question that happens that you see online, especially in some of these financial forums, and it has to do with owning stocks in retirement. Now, there is a big method out there that says that the older you are, meaning as you get into your 60s, 70s, 80s, that you should keep your risk to a minimum. In fact, the older you are, you should allocate fewer stocks to retirement.
Have a lower percentage of stocks as you get older?
Correct. Your retirement as you reach 80. Yeah, we brought this up many times. That's a horrible adage. What is it? It's not even an adage. A theory? No. It's a
stupid rule of thumb.
Okay, we'll go with rule of thumb.
I know where you're going. That's why.
Yeah, 100 minus your age, and
that's how. But I've never had a good answer. Is that 100 minus age? And the answer is how much you should have in stocks or how much you should have in bonds. Probably stocks.
It is stocks. So if you're 70 years old,
you should have 30% in stocks.
30% in stocks.
That's
if you're
bogus.
80 years old, you should have 20% in stocks.
Well, first off, that presumes that every 65-year-old has the same risk tolerance, the same goal,
same
need, the same everything.
Yeah,
and that's just not a true statement either.
Well, no, it isn't. But look around you, though, Professor Plum.
So when I get to 100, I should have no stocks. When I get to 105, I should be shorting the market and be negative in the stock world.
That's right. You should. They didn't say what happens when you get to 105. Negative stocks. I guess that would be shorting it, right?
Yeah.
I don't know. But look around you. I mean, you have this rule of thumb that we mentioned. You have people who will go out there and they should say, it's really pretty risky. You don't have a lot of time left, supposedly. You have less time, obviously, the older you get. And even when you take a look at things like target date funds, which should not, target date funds are for people before retirement. I mean, this is the thing that's supposed to take you up to retirement. Now, I'm going to get to that in just a second. But the idea is that as you get older and you approach retirement, you should own fewer stocks. I'm not going to refute that. But the way target date funds are set up, Professor Plum, is that if you kept it and you reached your target date and you retired on that date, you're going to keep that same very low allocation to stocks, are you not?
That's the way a target date fund is developed. Once you get to that target date, they stop. The further away the date is, the higher the percentage of stocks. And the percentage of stocks goes down as you get closer to that target date. Once you get to that target date, it doesn't mean you're at a 0%, but whatever the percentage is, whatever the balance is between stocks and bonds in that target date fund, Now it stays there for the rest of the time that that fund is in existence.
So you are not in the camp, Professor Plum. I'll just say right up that the older you are, the fewer stocks you should own. In fact, if you know what a bucket strategy does, it almost by default increases your allocation to stocks
Over time.
over a long period of time.
I think the allocation percentage to stocks is not, age has nothing to do with it. Your goal has everything to do with it. How you need to spend money. So there's two aspects. There's two ways to look at this. One is the financial aspect. How much can I actually afford to have in stocks? And the other one is, how much do I feel that I can feel like having in stocks? Because emotional considerations, my risk tolerance, it may be different than what my financial needs are. But the first thing to look at is, how much can I financially afford to have in stocks? And the reality is, the lowest percentage of stocks that you should be allocating to is the day you start your distribution strategy.
In other words, the day you retire.
If we're going to talk about retirement, but if we're looking at education funding or any other funding, it's the least amount of stocks is when you start your distribution. But as I go through it, I'm still looking at how much should I have in stocks going forward. And I know a lot of, especially wealthy individuals, who their percentage of stocks goes up dramatically as they get older. And it's not because, we don't have that much time left. There's a couple of reasons. One is, they may not have that much time left, but they have plenty of money in safe investments to give them the cash flow that they need. And so they're actually looking at investing this money more for their heirs than for themselves, because they're never going to spend it. The other thing is, a lot of them have huge capital gains in their bucket number 3 because it's a personal portfolio.
Right.
And they're not going to sell it during their life. They don't need the money. They don't need to sell those assets to create the cash flow that they need. That's why they've done proper planning elsewhere. And they've got this stock, and they say, well, why would I want to pay the taxes on it when my kids, grandkids, whoever it is going to inherit it and not pay taxes on it?
Well, that would be a very financially savvy individual, I think.
We see that
who thinks
quite
about
a bit,
that
actually.
kind of thing. And it's true. It's true. I mean, if I own a stock at a $10 basis and it's now worth $50 per share, I mean, why would I sell that and incur a large capital gain if I don't need to sell it?
Right. And it does go up and down, but, I'd rather...
All right.
I don't need the money, so what do I care? That's what their attitude is.
Okay, so we're going to divide up into two different sections here. One is, of course, the period of time where you're accumulating your assets.
Right.
And then the time where you start distributing your assets. That's that point. You said when you reach that time and you flip it to the distribution phase.
That's the lowest allocation of stocks that you would potentially ever have.
Okay, so let's be clear that as you approach retirement, Professor Plum, you're saying that it's a good idea to sort of pare down your exposure to stocks?
Yes, I do believe that as you get closer to the date that your goal is, you have fewer and fewer stocks, less of a percentage of stocks as you get there. Understanding how much you need from an income standpoint helps you determine. That's one of the benefits of an actual bucket strategy, is it can actually tell you how much you can actually afford to maintain in the stock world. It may be saying, you know what, right now you're 65 years old, you want to retire next year, you're 92% in stocks. That's a little high. And then the question is, well, if that's high, what is appropriate? Let's create your strategy. You need X amount of dollars. So you need this much in bucket number 1, this much in bucket number 2, and this much can be allocated to the pure stock market portfolio. You have just identified the risk financially that you can afford to take. And it's a wonderful feeling knowing that I am not over or under allocated to my portfolio. Now, as time goes on, by definition, the percentage of stocks in my portfolio using a buckets plan is going to go up, at least for a while, because in a typical, we've talked about it before, maybe I've got 30% in bucket number 1, 30% in bucket number 2, and 40% in bucket number 3.
And the 40% represents the stock
40%.
portion of your portfolio.
But what
so
am I
40% of your portfolio is in stock.
Right, but
now.
what am I doing with bucket number 1?
You're drawing it down.
I'm spending it down. So over the next 7 years, I'm drawing that 30% down to 23%, down to, I'm drawing it down to 0, theoretically after 7 years, and then refilling it with bucket number 2. By that, and then over that time, bucket number 3 hopefully is growing at least at the same rate as I'm drawing down the other. So by definition, bucket number 3 is becoming a larger percentage of the overall pie. Now, as we go through our life and as we go through management of it, we will pare back bucket number 3 and refill bucket 2 and 1. So we'll kind of go back to the lower percentages over time from a risk management standpoint. But that's something that happens based on what has the market done for me over the time. Has it been beneficial? Is it now a good time to refill bucket number one? But by definition, we're drawing down bucket number one, allowing bucket number three time to grow.
It's just that's what happens in default. If I take one out of one side, my proportion gets bigger on the other side. So as we approach, people, let's say, save in their 401k during their accumulation period. And they're aggressive. They're 100% aggressive, let's say, because they got time on their side. They've got 20, 30 years.
So you're 25, you start off with 100% in the stocks.
Right, and fine, because you got all this time. Now, as you get up older and you get into your 50s and you start approaching retirement, you want to retire around 65, this is where perhaps somewhere in there you start to pare back that exposure to stocks. Now, why? It might seem obvious, but why do you pare back your exposure to stocks?
So that I can still control my financial destiny. I do not have to worry about what the market does. I don't want the market to control my financial destiny. If I'm 62 right now and I want to retire at 65, I don't want to stay 100% in stocks, because what happens if at 64 and a half, we run into a 73, 74 downturn, a 2000, 2001, 2002, 07, 08 through early 09. And I look at my overall portfolio, because I was aggressive and I was getting all the juice out of that thing that I could get. I wanted to go right up till the day I retire. And all of a sudden I lose 25%, 30% of my portfolio. Now I'm not so comfortable retiring the way I thought I was going to. And so that's why we don't wait till the last minute to allocate towards the safer areas as we get into the window, so to speak. Now, we don't allocate the new contributions. It's not like, okay, I'm going to say stay 100% in stocks in my existing portfolio, and the money that I'm saving every year, I'm maxing out my 401k, I'm putting my $30,500 in, and it's all going to go into bucket number one, because I'm going to build up my bucket number one over the next 3 or 4 years.
No, that's not the way.
That doesn't do you any good. You're not getting any juice. There's no vig to it. So what you do is you take and safen up existing assets. If you need $200,000 in bucket number one, you carve off $200,000, put it in the bucket number one, but you continue to dollar cost average.
In your 401k you're talking about.
Or anything that you're saving into. The money that I'm saving today, if I'm 62, 63, 64, going to retire in a few years, the money I'm saving today is not for the first year of retirement, second year, third year of retirement. It's for the longer edge of my retirement.
Which is why you've pared back before you reach.
That's why I've changed my allocation of the existing assets.
Yes, and the irony, if you want to call it that, or the paradox of this, and when you compare it to other people who say you need to pare back your stocks as you go through retirement, would be that infers that your stock allocation should be at its almost highest point by the time you reach retirement, which you've just said should not be the case.
That's wrong.
So,
because stocks do equate to volatility, and volatility handled incorrectly equates to risk.
Yes.
I do not want the maximum amount of risk just before or right after I retire.
Yeah, that's the point. All right, so now as we talk about how much you should own in retirement, now there's no specific percentage, Professor Plum, because
it's driven by your needs.
Everybody's situation is, of course, different. But you're finding out that it's not it's not actually inherently risky to go from 65 to 75 to 85 and have a higher percentage of stocks. A higher percentage at age 85 than you did age 65.
What risk are we talking about? Is it risky that the portfolio may go down in value? True. Is it risky that I'm going to miss cash flow that I otherwise want? As long as you've taken care of your cash flow
with a bucket strategy,
then the rest of it falls into place.
Yeah.
If I'm a 95-year-old and I need, $20,000 a year, do I need to have 95% of my $1 million in cash because I'm 95? No, I need to have enough in cash in safe accounts, CDs, T-bills, and things of that nature to be able to draw down cash flow that I might need over the next, the next 10 years.
Till you're 105.
Yeah. Well, and let the market do what it does and invest it further. The risk there is that you die and your heirs have to hold on to the stock a little while before they sell it, or they may get a few bucks less than what you had, and that's the risk.
Okay. You've got the safer part. We'll call it your bonds or whatever.
Your bucket one.
Your bucket one. It's paying more now, earning more now than
Well,
it
than it
did
did 5 years ago. Yeah.
Yeah. So if it's earning more, are you able to allocate less money to
Yes.
that? Because there are some people say, well, gee, it's earning a lot more. You know, I can get 5% on a money market or whatever right now, variable. So why wouldn't I allocate more to that?
Well, you can, and I do have people that now. So we talked about that. I talked about there was two different phases to this. There is the financial need phase, and there's the emotional need. How much risk am I willing to accept or how much return do I need to get to accept that risk? And some people will say, you know what, 5% is fine with me. I do not want to take the risk of the market and hopefully get 8 to 10% when I can get 5 without any risk. So, but that's now going away from the goal-oriented funding. And these are the only people that can really do this type of planning are the people that have more than enough money to meet their needs.
That's why I hesitate. You said the risk of the stock market. I almost hesitate to call it risk of the stock market.
The volatility of the stock market.
Yeah, because honestly, where is there risk in stocks? We've said this.
In a broad diversification, or a decent diversification of stocks.
Yeah, where is there risk?
The risk is short term.
The only risk is if I got to have that money tomorrow or next year or next month or whatever, or 5 years from now.
The risk is I got in 2021 when the market was up almost 30%, and now it's 2022, and I'm down 20%. And I need to sell the money to pay my property tax, to pay my kids' tuition, to pay whatever.
There it is.
That's the risk. But if I've got 10, 15 years, from 2021, if I had 3 years, we're okay.
Well, and the problem with all this generic advice, Professor Plum, is that it defines stock market as risk no matter what. You know, I don't need the money for 20 years. Maybe I never need the money. 15, 20, 25 years. How is that? Where is the risk if I put money into the stock market? I mean, I suppose there's a risk.
The risk is that I'm too emotional to handle it, and I sell out when the market goes down because it scares me. That's not the risk of the market. That's the risk of me.
Right, exactly. So it's just kind of an interesting paradox there. Everywhere that I read,
I think we need to drive home the point that volatility is not risk.
Boom.
Your reaction to that volatility can be risky or it can be opportunistic.
Volatility is risk in the sense that I got to have this money soon. I need it. So please, let's roll the dice. That turns volatility into risk. But volatility is not in and of itself, by definition, risk.
Volatility is in the market we're talking about is a fact of life.
Yeah.
It has people talk, the markets are getting more. The markets have always been volatile. There's never been a time where the markets have not been volatile.
Yeah.
It's just that sometimes the volatility tends to be on the upside only, and we get used to that, and we think, well, this is the way the market always goes. Well, the volatility goes both ways, up and down, and we have to be able to protect against it when we need to, and we want to be able to take advantage of it when we have that opportunity, which is long term.
So if you define volatility as, it's the ups and downs of the market. But if you define risk as being, and equate that with volatility, you're saying that the only risk there is that if you need the money right away.
Right.
So
there's risk of not being in the market too. The risk of not earning very much. Well, that's a risk.
That's missing out, I suppose.
The risk of missing out.
Yeah. The RIMO.
FOMO.
Yeah, well, there's FOMO, fear of missing out, but risk of missing out would be Romo, who I think is a quarterback.
Used to be.
Well, was. Now is a kind of an annoying sportscaster. All right, but that's neither here nor there. So when we talk again, as we bring this back to our point, and I hope people are picking up on this, is that when people ask how much should I own and how much in stock should I own when I'm retired? In retirement, how many? What percentage? And obviously, it depends on.
Well, it's not a matter of your age. It starts with your goals. Let's tailor your investment strategy to your goals, and then once the goals identify the allocation, then let's tailor that to you emotionally. I know people who have the ability to have 30, 40, even 50% of their money in stocks. But emotionally, they don't have any money in stocks. They don't want to see a negative return ever.
Okay.
And they're in a position where they can afford to not have to take that risk to get the return, to get the cash flow that they need. So some people have that luxury that their portfolios can exist, can create their goals with a lower potential overall rate of return necessary. Some people don't have that luxury. They need to get a little bit better rate of return. They need to have that stock component because they retired early or they have longevity and they need to offset going forward.
So if somebody said, Professor Plum, how much should I'm retired. I just retired. I've got X amount of dollars. What percentage of this should be in stocks? Your question would be, well, let me ask you this. How much money do you need and when do you need it?
Well, it's like when anybody, and it comes up more often than you think, comes in and says, what's a good investment for me? Okay. What are you trying to accomplish?
I know what they're trying to accomplish when they ask that
question.
question.
They want the greatest rate of return, tax-free, guaranteed.
Yes, with the least amount of risk, guaranteed.
That's not going to happen. So
no. All right.
Tell me what it is you're trying to achieve. What is your goal with this money? Well, the reason I have this money is because I just sold a house, and in the next year or two, we're going to buy another house. Okay, well, that's a different goal. Oh, how much of this money are you going to need? Oh, we're going to need it all. Okay, well, and if a year from now it comes back as 20% less, is that going to affect your ability to do what you want to do? Oh, yeah, that's going to affect it dramatically. Okay, then you cannot take the risk of trying to get a better than a CD, T-bill type of rate of return right now.
Well, it would be risk because you need the money soon.
You can't afford to take expose yourself to that kind of volatility.
Yes.
And the reality is over a year, the overall return differential, you could earn more money in the stock market. You could also earn less money in the stock market. But the amount, compounding hasn't had an opportunity to take effect yet. I mean, it's 1 year return difference is, okay, it's a little bit, but it's not going to make or break your ability to live like losing 20% might. So why take the risk to get it? So what is the goal? What are we trying to accomplish? We sold this house and we're not going to buy another one. This was we already have another one that we're moving into, smaller house, kids are gone and things like that. So this is actually money we don't need. It's for the kids.
20 years from now.
Yeah, hopefully more than that.
Whatever.
Or whatever they say. Okay, then that changes the dynamic of the properties of what we're trying to achieve with this money. The goal is different. And because it's not the age that was different,
it's the time horizon.
It's the reason for the investment. And the reason for the investment is your reason, and it should be tailored the solution should be tailored to what you're trying to accomplish.
So if they say, I don't need this money, as you just said, it's for the kids, we hope it'll be 20 years from, we're going to put a 20-year time horizon on this. The stock market that was very risky to the person who says, I need this in 2 years.
Right.
If I can say that, there isn't risk to this investment for the person who doesn't need it for 20 years.
And now it becomes, the question right after that is, okay, now do I put it all in today? Or do I dollar cost average?
Okay, so let's say you got a house sale, you got $500,000. That's okay.
You got a big mortgage on it in California if that's all you got.
Well, that's a fair question though. That's a fair question to somebody who's got this money. If I'm going to put this into the stock market, I don't need. I
have accepted the idea that yes, this money should be in the stock market, but I'm also leery of the fact that if I put it all, I am Murphy's Law incarnate. And if I put the money in today, the market's going to go down 20% the next day,
and that's not.
And while I understand it financially that over the long 20-year period of time, it's not going to matter that much, my psyche don't like that.
No,
and my ability to sleep at night may not really like that too much.
Well, you'll be missing out on the sale of, the stocks will be on sale. So how does somebody determine that?
Then now it's just a matter of what does you've agreed with the premise that you want to be in the stocks. How do we get in stocks? Stocks are up, 3 out of 4 years. Give or take, historically,
no guarantee going forward.
But if you're talking to somebody like me who is Murphy's Law, I will find the next 1 year. I mean, that goes down.
You personally?
Oh gosh, yes. I mean, it's just what can go wrong. So I've got to think about that. And will I be able to accept the downturn if it happens? If I can't accept that downturn, turn my back to the market for the next 10 years, then you may want to think about staging it in now. How long are you going to take to stage it? This all becomes a problem in that one question leads to another. How long is it going to take to stage
So I'm
it
not
in?
going to, in my example, I'm not going to dump all 500,000 into the market. I'm going to do this.
100,000 a year for the next 5 years.
Now, of course, there's risk.
Now I'm fear of missing out on the upside.
Right. So it's more of an emotional game than anything else.
That's a huge emotional game.
Yeah.
I was talking to a young recruit this morning about when I got into the industry, I thought having a finance degree, economics degree, accounting degree was the most important thing to have as a financial planner. And through the years, while I still think those are incredibly important, I'm thinking a psychology degree is also, I don't have that, but I have the, it's very important because a lot of the things that we are trying to do, we try to do it through the strategy to help allay the fears of the emotional issue. But the emotional decision-making process, it can be more detrimental to anybody's financial plan than the market could ever be.
Well, you've got the two people on the shoulders. You have the one saying, jump in right now. You know,
little devil and little angel.
Right, and one saying, yeah, Paul, all in, go. And the other one saying, oh, no, take your time,
Sell now before you lose it all.
Well,
no, stay the course.
Well, yeah. So it's very hard, and this is, I think, where a good financial advisor can help.
Well, that's definitely one of the values of a financial advisor, being a sounding board.
A sounding board, and maybe a counselor in many ways.
Oh, very much so. That's why I think a psychology degree helps.
Well, in that case, though, Professor Plum, would you err on the side of caution to somebody who is just a little skittish? You say, well, then listen to that person.
It depends on the person, and depends on how much money we're talking about. It depends on their attitudes that there's a lot of reading into people, what's going on, and whether or not this is a large enough piece of is it $100,000 that they got from selling something, and they've got $2 million in their overall portfolio, or is this $1 million they got from selling the house and they have 500,000 other than that?
Yeah.
Okay, those kind of things matter. Right?
That's true. That's
so
true.
We'll go back to what's my favorite answer.
It depends. Well, so to encapsulate all of this, as we talk about, because I think the question is at the top of the show, how much should you own in stocks in retirement? Well, again, it depends. That's not the only question you should be asking. You say, okay, Professor Plum, how much should I own in stocks in retirement? And you would say, well,
let's talk about your goal.
Yeah. And what do you mean my goal?
What do you need this money to do for you?
Well, okay.
I need it to double overnight, dang it.
Because I owe.
I owe, so off to work I go.
Yes, I got these gentlemen outside with, dark
hats. Sunglasses.
Right. No, that's the question. There cannot be a pat answer to that question until you have other questions answered.
Well, until you know why you're doing something. I'm going to drive cross country. How are you going to get there? I don't know. I'm going to head east, or I'm going to head west, depending on which coast I'm starting from.
Yeah.
Well, how long is it going to take you to get there? Well, if I've got to be there in 4 days, I better have a good route planned out.
Well, you better be aggressive in that driving.
We've done it faster.
All right, but you know what I'm saying. I'm comparing this to
what was the 28 hours? Was 28 almost 29 hours was the record?
I know. I missed that. I don't know.
Somebody did it in 2021
drove across the country.
Did a Cannonball Run-ish, type thing.
Well, you're not on the freeways. You're not hitting.
They averaged 110 miles an hour.
I don't want to think about that. All right, but your goal. You know where your goal is. So,
right. So is my goal to get there really fast? I better have a plan of action. If my goal is to get there in the next 6 months, I can do all kinds of things. So let's talk about what it is you're trying to accomplish, and pick the appropriate strategy for that goal and what you're trying, how time horizons.
Yeah. So I got a bunch of money, but I'm going to need it in the next few years. Well, then you should probably have very little, if any, maybe none in the stock market. If you don't need this money for a long period of time, maybe ever, then if you're comfortable with it, you can put it all in the stock market.
And don't listen. Hey, bub, I got something for you. Come on. Now, you don't want that safe stuff. I can pick the right thing. Hey, bub, come on.
Hey, bud, come here a minute. Where you going?
Yeah.
Where you putting that money? In a CD?
That's from the Jack Benny show.
Better. Yeah. Open up the coat and say, I got something for you right here.
Yeah.
We don't want to give the impression that there is a pat answer, because there isn't. But it's just a question of what you need to do with the money. I hope that's answered the question for people here, though.
It's like, hey, doc, what's the best medicine you can give me? For what?
Yeah, exactly. Yeah.
What hurts? What's the problem with you?
Well, and it's funny when you said people come to you and they say, "Well, what's the best investment for me?" And I mean, that's a question that has no answer until you've asked a few other questions.
Right.
And it all comes down to, what are your goals? And that's what I think a good advisor is going to do. They're not going to give you that answer, People listening to this podcast
Not without knowing a little more about you.
People listening to this podcast probably said, oh, man, you were supposed to tell me that when I'm retired, when I'm 80, I should own this percentage, and when I'm 90, I should own this percentage, and at 65, I should own this percentage.
Yeah. Nope.
But you've got to think about it for yourself, and you've got to understand what is the goal for this money.
The reality is you're a couple years younger than me, but your goals are different than mine. And based on what I know about you, you should have less of an allocation to stocks than me.
Yes.
But I'm older than you.
Well, see, and there you go. That just flies in the face of
exactly. That's why I brought it up.
100 minus your age? I mean, come on.
I'm almost to zero now.
Well, I talked to you this morning about a money market that, I said, I'm going to need this over the next couple of years. This is great stuff. If you have questions about any of this stuff you want to know about, this is kind of the asset allocation discussion.
Well, buckets in its purest form is identifying the appropriate asset allocation and how to use those allocations and manage and monitor to your advantage based on your goals.
Yeah. And then there's asset location, which is a whole
Tax planning comes next.
Yes. Yeah, that's a big part of it as you start to distribute those assets. You want to get in touch with Professor Plum or any of the Lucia Capital Group advisors, 800-644-1150. Talk to them. Get your asset allocation in order. And don't believe everything you see. Don't believe everything you read online. 100 minus your age? But even if you don't look at
crock.
Well, it is. But even if you don't look at that, you're still going to find people out there who are saying, there's risk in stocks, so you really got,
No, there's volatility in stocks.
There you go. How do we hammer that home even more?
I don't know. We're trying.
There's volatility. Well, is volatility risk? No.
Well, it's risk if I don't use it, I miss out on potential return over the next 10, 15 years.
That's it.
And there's risk I miss out on real return if I use it the wrong way for short term.
Well, see, there you go. That's all part of...
But volatility is a fact of life with the stock market.
How do you react to it? Exactly. 800-644-1150, 800-644-1150. Don't forget, we talked bucket strategy quite a bit. We've done a lot of buckets discussions over this past season.
Because we live and breathe buckets.
Well, and the more I read outside, the more advice that I see out there, it all kind of leans back to one thing, which is you need to have a strategy that's going to help you,
It's been stress tested.
Yeah, I hesitate to say. I mean, it's not perfect. I'm not going to say that there are
strategy is perfect.
No.
But, I mean, you can screw up any strategy.
Well, you can. It's just a question of, who's doing it. Talk to Lucia Capital Group, 800-644-1150. We have this guide. That's what I was going to say. Don't forget, go online, get your guide, your free guide at luciacap.com, LUCIACAP.com. Type in the search area up top on the upper right, bucket strategy. You'll see the guide come up first. Download that, read it. And it helps to understand not only the strategy itself, but why we believe in this. And if you do read it, I think you're going to say, okay, now I get it. Now I understand why they're talking about this so much and why it's, when done properly, can help.
Oh, yes.
Potentially. LuciaCap.com. Let's see. What? Podcasts. As I mentioned, we're getting close to 200 episodes. You folks got to subscribe.
Still a few more to go, but be here for our 200th.
Absolutely. Maybe we'll have a piece of cake or something. Subscribe.
Cake.
I think we got some cake waiting outside of the studio here.
Somebody had some.
Somebody had a birthday today. Let's see. You go to Apple, right? Apple Podcasts and Spotify. I don't take notes.
Well, also, you got cake on the brain right now.
Well, I do. And I should have said at the top of the show, because I have my cheat sheet now. Got last week.
Thank you, listener. Joe, was it?
Yeah, Joe out in Indiana. I'll say is where Joe was. Rick Plum, certified financial planner professional. I should have said that at the beginning. That's what you are.
He's got his laminated cheat sheet here.
And you are an accredited wealth management advisor, AWMA.
Yes, sir.
Look at that. Oh. I just have to remember to say it now. I should have said it right at the top.
We didn't even say our names at the top of the hour.
I think I said mine. I think people just know who you are. Anyway, that's all I've got. Professor Plum, thank you.
You're welcome.
As always. Until next time, for Professor Plum, I'm your podcast host, Johnny Dean. Managing your financial future. Talk to you again next week. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. An asset allocation strategy does not ensure a profit or protect against loss. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. We cannot assure the accuracy or completeness of these materials. The information in these materials may change at any time and without notice. This material should not be considered a solicitation of an offer to sell or buy any specific security or offering. Investors should consult a financial professional to to determine whether risks associated with an investment in the shares are compatible with their investment objectives. A dollar cost averaging strategy does not guarantee a profit or protection from loss. Since such an investment plan involves continual investment in securities regardless of fluctuating price levels, you must consider your willingness to continue purchasing during periods of high or low price levels. Diversification strategies do not ensure a profit and cannot protect against losses in a declining market. 401k benefits may be subject to change at your employer's, the governing pensions, or benefit organization's discretion. It is important to keep in mind that investments in fixed income products are subject to liquidity risk, interest rate risk, financial risk, inflation risk, and special tax liabilities. Interest may be subject to the alternative minimum tax. Treasury securities are backed by the full faith and credit of the U.S. government, but are subject to inflation risk. Target date funds are subject to the volatility of the financial markets, including equity and fixed income investments in the U.S. and abroad, and may be subject to risks associated with investing in high yield, small cap, and commodity-related foreign securities. Principal invested is not guaranteed at any time, including at or after target dates. Before investing, carefully consider a target date fund's mutual funds, exchange-traded funds, investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus, which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. CDs are FDIC insured up to $250,000 per deposit or per insured bank for each account ownership category. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.